Welcome back to Factful Finance. Today we're diving into a question that shapes the very foundation of our financial world. How do central banks control the economy with monetary policy? The role of these institutions might not always be visible in your daily life, but their impact is everywhere, from the price of your morning coffee to the stability of your job. And yet, despite their importance, central banks often remain a mystery to most people. Ever wonder why interest rates change? Or why sometimes inflation feels like it's running away from you? This is where monetary policy comes in, and today we'll break it all down for you, so you understand the tools central banks use to steer the entire economy. Buckle up, this is going to be a fascinating ride. First, let's make sure we're on the same page about what monetary policy actually is. Simply put, it's the process by which a country's central bank controls the supply of money and influences interest rates to achieve specific economic goals, such as controlling inflation, reducing unemployment, and stabilizing the currency. These goals are key to fostering a healthy economy that works for everyone. So, how do they do it? It all comes down to a few core tools: open market operations, the discount rate, and reserve requirements. Let's take a deeper look at each. 1. Open market operations, OMOs. OMOs are perhaps the most well-known tool in a central bank's toolkit. Simply put, the central bank buys or sells government securities like bonds in the open market to adjust the amount of money circulating in the economy. When the central bank buys bonds, it increases the money supply, making it easier for businesses and consumers to borrow money. On the flip side, when it sells bonds, the money supply shrinks, making borrowing more expensive and slowing down inflation. Imagine a scenario where the economy is overheating, with inflation rising fast. Central banks might step in by selling bonds to pull money out of circulation, thereby cooling down the economy. The discount rate. This is the interest rate at which commercial banks can borrow money directly from the central bank. When the central bank wants to stimulate the economy, it lowers the discount rate, making borrowing cheaper for commercial banks. These banks, in turn, can lend more to consumers and businesses, boosting economic activity. On the flip side, when inflation is creeping up and the economy is growing too fast, the central bank can raise the discount rate, making borrowing more expensive and slowing down spending. 3. Reserve requirements. This tool is all about controlling how much money banks must hold in reserve. By adjusting the reserve requirement, central banks can influence the amount of money banks have available to lend. Lowering the reserve requirement allows banks to lend more, which stimulates the economy. Raising the reserve requirement reduces the money banks can lend, cooling the economy down. Now let's add some real-world context to these concepts. Consider Emma, a small business owner. A few years ago, during an economic downturn, the central bank decided to lower interest rates and buy bonds to pump money into the economy. Emma, noticing the drop in interest rates, was able to secure a loan for her business expansion at a much lower cost than before. As a result, she hired more employees and her business grew. But just last year, with inflation rising, the central bank raised interest rates, making borrowing more expensive. Emma found it harder to get a loan, and her expansion plans slowed down. This is the central bank's influence in action. But how do they decide when to use these tools? Central banks rely heavily on economic data, everything from inflation rates to employment statistics to consumer spending. Their goal is to create a stable environment where businesses can thrive, people can find jobs, and prices don't skyrocket. Now here's a twist. Central banks just react to economic conditions. They anticipate them. They're forward-looking, making decisions based on economic forecasts and models. They know that monetary policy doesn't work overnight, so their decisions are made with the long game in mind. So how does this all come together? Let's say inflation is rising too quickly. The central bank might raise interest rates and sell government bonds, pulling money out of circulation. This makes borrowing more expensive, slows down consumer spending, and reduces the pressure on prices. In the best-case scenario, inflation stabilizes, the economy cools, and everyone can go back to doing business as usual. But here's the thing. These decisions aren't always perfect. The economy is a complex system, and central banks often have to make tough calls. For instance, Raising interest rates too quickly might slow down the economy and lead to a recession. Lowering rates too much could risk inflation spiraling out of control. That's why central banks walk a fine line by adjusting their policy tools carefully and deliberately to balance growth with stability. So, what does this all mean for you, the everyday person? Understanding these processes empowers you to make smarter financial decisions. When you see interest rates climbing, for example, you know that the central bank is trying to cool off the economy. It might be time to rethink large purchases or loans. On the other hand, when rates are low, it might be the perfect opportunity to invest, buy a home, or expand your business. Monetary policy shapes everything from your savings to your job stability to the cost of living. And now that you know how central banks control the economy with these tools, you can see how much influence they truly have. If this was eye-opening for you, don't forget to hit that like button and share this video with someone who could benefit from understanding how central banks impact their wallet. And remember, this content is for educational purposes only. Consult with a certified financial professional to tailor advice to your personal situation. Got questions or thoughts about central banks and their policies? Drop them in the comments below. I love hearing from you. Stay tuned for more insights. And if you haven't already, hit that subscribe button so you never miss a new episode of Factful Finance. If you found this helpful, you'll love the next topic we'll be covering. Click the video on screen now to keep learning.